Welcome to A Few Minutes with Peter Grandich. I'm your host, Al O'Grady, and for the next few minutes, we'll be talking to Peter, getting his insights on the markets, commodities, business, politics, sports, and life in general. Peter Grandich is the editor of the Grandich Letter, which was first published back in 1984. He has been a market strategist, a portfolio manager of 4 hedge funds, a mutual fund that bared his name, and is widely known for his accurate forecasts and no-hedge markets perspective. He appears regularly on television and radio and is widely sought after in leading financial publications. He's also the co-founder and managing member of Trinity Financial Sports and Entertainment Management Company, an insurance and estate planning firm specializing in servicing professional athletes and entertainers. Peter, as always, welcome back to the program.
Always a pleasure to speak with you, Al.
Okay, thank you. Peter, this is our last show for 2012. Where did the year go? I think we should take a look back at the markets, a year in review, if you will, certainly with the markets that you follow. I'd like to get your own report card, what you thought would happen and what actually did happen. So let's get the worst out of the way by starting with the junior resource market. You said this was the worst market for you in 30 years. Peter, what went wrong? Why did it go wrong? And is there any hope of it getting any better?
There's no question in my mind and in my portfolio, it was the worst market ever in the almost 30 years I've been in and around Wall Street. And perhaps the most frustrating part, other than looking at 7-figure losses, is it's still hard to explain even after going through it. You would expect after hindsight being 20/20, it would be easy to point and say this and that. And the biggest frustration of it all was that the underlying metals that most of these junior resource companies go after basically had a decent year. They certainly didn't drop a lot, and normally that would be the reason you would think as a group things would lose 50 or 70% or more. I think there is some hindsight analysis that helps explain it, and maybe it's going to be necessary to appreciate that going forward, and that just goes back to some of the things. I won't rehash them all, and I'll just quickly go through them, and that is that the game has changed despite the great amount of increase in the overall metal prices. The number of players have dwindled for a lot of reasons we discussed before. The regulatory, the inability to, in a sense, to promote to any great degree as was once done, the regulations, the time of these private placements being shrunk, just a whole series of things which I've discussed before and can be found on my website, I think all came together and really has at least greatly damaged the market. So one of the mistakes would be that while tax selling and losing stocks to get rid of because there's such mental tolerance should cumulate by the end of the year, I don't think we should think we wake up January 2nd and it's happy days are here again. So the hope would be that after a time of base building, after a number of juniors consolidate, roll back, and or disappear, only then will we be able to have any sustained bull market up, even with metals rising. So I am cautiously optimistic at best, and I'm concerned that the markets we grew accustomed to through the 90s and the early part of the new millennium may have changed forever, and I don't know what that will finally mean, but it's certainly going to mean things will be tougher in the junior resource market for the foreseeable future.
Peter, something that you said that is certainly noteworthy of a follow-up. You had mentioned 7-figure losses. I would think that, and you also said that you're cautiously optimistic. Someone that has experienced those kind of losses, I mean, the markets are a function of fear and greed, and you got to wonder if that would really be fearful, certainly for a lot of other people. How is it that you can remain cautiously optimistic?
Well, sometimes you think it's only because that's the only other choice you have other than going into your third bout of depression, which I don't wish to do anymore. I hope that when I wrote about it in my book, the last one was a few years ago. So, I don't want to paint doom and gloom to the extent. What I just don't want people to assume that just because the year ends, this horrific bear market we had, just simply, returns to happy days are here again. The cautious optimism comes from this fact. I think I calculated, and I may be off, but I believe there's been 11 bear markets on the venture exchange, which means declines of 20% or more, going back to the mid-1980s. I entered the brokerage business in '84. And so if there's been 11 of them, and maybe it's 9, I don't remember exactly, but the number 11 sticks in my mind, well, that also means that there were 11 new bull markets that followed. And for my cautious optimism, I guess we're hoping for a 12th. One of the things that inevitably happens here is there is a great consolidation, and then the survivors, the companies that actually made it up the food chain and became producers or emerging producers, they got so punished during the decline that when it's seen that they are going to be the exception to the rule, money flows back to them. What I don't think is going to happen, as much as you would think that part of my livelihood is in a business where this would help me, but I'm trying to be realistic, is I don't think it's going to be an all boats get lifted recovery. I really think if and when a new bull market comes to the junior resource market, it's going to be more thorough in what it participates in. I think people have, all of us, retail investors, promoters, investment bankers, mining executives, I think they've grown weary of the old style and the old expectations and are going to be more cautious and more realistic in their ways that they approach things. And that will actually make for a better market, but I still think that is many months away. I just don't see how this market, other than gold getting above 2,000, and that just brings in so much new interest, just like when the Dow first crossed 10,000. Without that, I just don't see this market turning on a dime and running up and staying up.
Okay, and you had talked about gold. We'll get to precious metals in just a few minutes. You've certainly taken your shots from your critics with the junior resource market, but let's give credit where credit is due, especially with the U.S. stock market, where you've been bang on. What's going on here as far as the Dow is concerned, and do you still see the path of least resistance to being up and not down?
Well, I thank you, and it's an amazing that you can be right in 80% or 90% of the area you speak of, be terribly wrong in one, and that's where the focus of the pain comes in, but that's the nature of the species, I guess. But the U.S. stock market has been a place that, I guess if I differed in any way of most others in the junior resource market, you will find very few equity bulls in people who ply their trade in the junior resource market. They're almost always bearish in general stocks and the stock market in general. And I kind of separated myself, and I emphasized throughout this past year that it would be a mistake to short this market, that despite a lot of bad fundamentals, despite a very dire time that I believe is coming to America, I'm going to write about it in my New Year forecast, nevertheless, the stock market would work higher, and the least resistance would be higher versus lower, and that played out. And while there's this fiscal cliff, and it will hang with us to the end of the year, and other concerns, it would still not surprise me, despite all that they do a patchwork deal, as they always do before. They put spending in now, and hopefully cuts down the future that never come. And sometime next year, certainly in the first few months, that the Dow actually manages to eke out a marginal new all-time high. Having said that, it is not a play that I would want to get very involved with and be long general equities. If one has to be or needs to be or wants to be long general equities, I would look outside of North America. I would focus where growth is really assured and continuing, a lot of it in the Far East, and even some rebound now in European equity markets, which were very well beaten up selectively. I can think of a little country like Ireland where I think they will manage to turn around and get their foots on the ground again. So I think the general U.S. equity market still is more likely to go higher than lower, but I think that will crest sometime in the first half of next year. And then I really think, unfortunately, things come home to roost. All the things you and I have discussed, probably to ad nauseum to some, come back and really take hold in America.
Okay, two things that you mentioned, and just as a follow-up. First of all, here we are, December 5th. Any sort of Santa Claus effect or Santa Claus rally for the month of December that you see? Very, very short term?
Normally it would be a no-brainer, but I think the fiscal cliff worries will neutralize it to some extent. But again, I don't think there's going to be a big drop-off either. It's very difficult for people to want to sell here from a professional level, and let's not forget institutional investors dominate the markets now. They have pretty well secured their bets for the year. They get paid, a lot of them, on how their performance is for the year. And so I don't see a big sell-off, but I think the Santa Claus rally can be neutralized by this fiscal cliff stuff, and it will all depend on how politically we get. And keep in mind, the last 2 weeks of this year are very, very illiquid. They're just very dry for volume, and so any moves, good or bad, will be overdone. But I just think the Santa Claus rally could be neutered this year, so to speak, because of the fiscal cliff worries.
And having said the fiscal cliff, that leads into my second follow-up. Personally, I think there's going to be some sort of agreement, and they'll leave it to the 11th hour on December 31st, and they'll come to some sort of terms. However, if you're an absolute pessimist and the two sides can't come to some sort of agreement, here we are January 2nd. Is the sky going to be falling if there is no agreement in place?
Well, certainly if there's no agreement and there's signs that they've all basically told each other to take a long walk on a short pier, that could spell trouble for the markets in the early part. But, you know, seeing what they've always done, knowing how unfortunate this political process works, I do see a patchwork. I do see them each having something to say they got out of it. And again, as it's been done for years now, as the debt level gets increased, they increase spending and talk about cuts and show cuts that never end up really coming. So that's where I think we're heading.
Okay, so let's leave the general stock market for a second. Another market where you were far more right than wrong, and that had to do with precious metals. So your thoughts on that right now?
Well, yeah, I would say we're probably net okay from performance-wise. I do think that, and again, as we record, I put up a posting, that I just in an interview a couple of days ago, fully anticipated because of what happened a week ago Friday, that there was a concentrated effort by the bears, and we're going to use this seasonally period to attack gold and to be prepared for it, and I'll wake up again and see that again today. But getting past this month and getting into 2013, the mother of all bull markets remains fully intact. There's no question now that the spigots have been opened, particularly here in the United States. Full printing of money is just going to continue. We're watching the Democrats speak about wanting to get an unsealed debt level. In other words, they can print money to infinity. These are all things that are bullish for gold long term. So no matter what little concerns and things that happen here in a drying up market for the month of December, I think 2013 will be another good year for gold.
Will that fiscal cliff have some positive effects for gold?
I think it's a mistake to think and play gold only because the world is supposedly end. I think the reasons gold has gotten here is that people with real sums of money outside of North America who are not looking for the world to end but recognize what is happening to currencies, particularly the dollar, and what's happening with debt levels all around. I think they recognize that more and more money will need to flow, and it continues to flow where there is growth in the world, in Asia. And so I just think that whether a fiscal cliff is solved or it does fall off, the main things that continue to drive gold are people's concern that they need something in an alternative to paper currencies, that there's no other currency large enough. Like, I still like the Canadian dollar and I like the Australian dollar, but I don't think they'll ever be large enough to be world reserve currencies. And I actually think that when we get over 2,000, and that's just a feeling of mine, I can't guarantee it, but I believe that we'll talk about a 2,000 plus gold in the not too distant future, meaning perhaps as early as next year. I think once that happens and it gets sustained there, I think that the small chatter that began in the latter part of this year about gold somehow becoming a backed currency for perhaps a new world reserve currency will take hold. And that's one of the reasons why I think certain countries are not only been buying gold, but are starting to talk about taking back possession of their gold. So I just think it's still, all systems go outside of what may happen in the next few weeks as we get towards year's end here, that gold is still in the mother of all global markets.
Do you ever foresee a day when currencies go back to using the gold standard? You know what I mean?
I don't think it's going to be a standard, so to speak, but I do think the inevitable out of this, there's only two outs really out of this now. I mean, for the United States, that's probably where I can speak best, is we've gone beyond the point of no return, and 98% of Americans still don't understand that, appreciate it, or even want to hear it. And that is the amount of actual debt that we have outstanding, which right now is somewhere between 17 and 23 trillion, not talking about the 50 to some people anticipate $500 trillion of unfunded liabilities or what have you. But the actual debt, we're getting to the point where from cash flow, which means simply after we pay all the things we need to live and survive, we don't produce enough soon to service the interest that we're going to owe. And that's why there's a big concern that if the bond market does collapse finally and interest rates go up a lot, America will not even be able to service the interest it owns, let alone the principal. So eventually, the answer to that is a reneging on the debt, a renegotiation of the debt, and a monetizing of the debt, which I think we're already seeing the Fed do the monetizing part. So all of those things are kind of no good for the financial asset, the dollar, and are extremely good for gold. And that's one of the underlying supports that I continue to believe, which you're not going to see day to day, hour to hour in the gold market, but the recognition by people, particularly outside of North America, that that's the inevitable ending for America, and one of the reasons why they don't want to own that reserve currency anymore like they used to 10 or 20 years ago, and they don't find another currency in the world strong enough that they can be in, and that's why they're parking their money in gold.
Okay, you had mentioned the U.S. dollar. We'll get back to that in just a second. Just one final thought regarding metals. You're certainly bullish on precious metals, but you are shying away from base metals. Base metals certainly did underperform this past year. Why was this, and is that trend going to continue in 2013?
I just think it's the general economic malaise which still grips most of the world, and there's no sight of that changing dramatically, at least for the first half of 2013. But at the same time, we mustn't lose sight that we still have so many more people living on the earth and in need of basic commodities, and therefore I suspect that we will continue to see base metals rise, but not at the level that the precious metals rises to.
Okay. You had brought up the U.S. dollar. Let's revisit that for a second. You certainly did correctly forecast a rally in the dollar and added that it would be going sideways after that. You've been calling it terminally ill in the long run. So has anything changed with the U.S. dollar?
No, just as I just explained, the inevitable is very bad for it. I think we will move sideways for the rest of the year, because there particularly people square off their books, and that's how you're going to hear the financial media reported probably starting as early as today and certainly in the coming days, the squaring of books. But I do think longer term it only has one direction, and that's substantially lower. And I might add that if you go back and look 3 or 6 months ago how the demise of the euro was predicted, and yet as we speak today, it's probably had a higher range now over the last few weeks than it had for several months. And while I don't think it's going to do much better than the dollar, it's going to be the lesser of two evils, which will only put more pressure on the dollar. The only saving grace for the dollar is the extremely overvalued yen is finally coming off somewhat, and that will cushion the decline. But I think when we get in the second half of 2013 is when we'll see the dollar start to really slide and go back to the low 70s in the U.S. dollar index, which will start to talk of a new down leg. But I still think it's sideways now, at least for a few more months.
Okay. For the second half of this year, you've certainly been consistent saying that bonds are going to be the worst investment for the next 10 years. Peter, for someone that's new to this show, why do you feel that way?
Well, I put up a little thing about the 12 days of Christmas, and I didn't actually do it. It was the PNC Group, Wealth Management Group, that did it. They actually saw what all those things that make up 12 days of Christmas cost, and they showed they were up almost 7% for this year alone. So this 1 or 2% inflation thing that the government tells us is out there is just not true. It's a lot worse. And now that we've basically turned the spigot as open as it can get, there's no more silver bullets for the Fed to use. Just a 1% or 2% increase in interest rates are going to just decimate bondholders because rates are so low now. So inevitably, even without an economic recovery, I think that's going to happen because the recognition is the jig is up, so to speak, in the U.S., and they won't be able to fool anybody. And even without a recovering economy, the dollar will come down and bond rates will rise, just as when it was suddenly realized Europe was in a bad spot, and you saw long-term rates in many countries go from 1%, 2%, 3% to 10% or more. And I think that's in the offering for the U.S. So it is the absolute worst place it can be. I have not yet pulled the trigger of getting aggressively short the bond market myself because I believe the quantitative easing can still hold things together until that Dow makes that marginal new high and kind of excitement returns and happy days are here again starts playing in the financial airwaves. And at that point, I still hope that like a 10 years below 2%, what have you, I hope to go aggressively short. But I just think it's a very bad investment. And unlike a stock where an individual company could develop a new product or service and do well despite the overall market doing bad, if interest rates go up, all bonds go down, and that's what I think it has for itself in the future.
Yeah, exactly. Okay, let's move on to oil and natural gas. Is it safe to assume that you're not paying that much attention to oil and natural gas, other than to say that you're still bullish on oil and natural gas is seeing a natural bounce as we head into winter?
Yeah, I don't hang myself out, nor do I think I want to be a so-called expert. I think it's fairly obvious that slow economies have kept oil from getting much over 100, but at the same time, a war concern that's always there because of what continues to happen in the Middle East isn't going to get it to where it probably should be based on supply and demand in the $50 area. So, I just think, it's going to stay kind of where it's at, maybe in tough times get down to 65 and 70, and when things really flare up in the Middle East, it gets over 100. And natural gas is just too much supply of it. It is going through, as expected, a bounce because of seasonality and the winter needs. But come March, it'll start to decline again as, winter turns to spring. There's still just too much of it, a supply out there, and there's no real pent-up demand that's going to suddenly come into the market.
Okay. All right. So that's a look at the big picture, macroeconomics. Let's go from a macro to a micro perspective. Let's talk about some individual companies. Anything that you'd like to share with us? Anything that's on your radar?
Well, despite, at best a cautiously optimistic view for the juniors, I do think things now at today's prices have become somewhat ridiculous. And if you don't believe the world is ending, some of these things, are going to rebound. I think the old iron ore market was overdone, and we already started to see some of them lift off the bottoms. But Alder on iron ore, which is a client, I have a large stake. I just think, it can be worth a lot more than it's currently selling at. I think, another company, and I think whether it's this company or companies in this situation are going to be among the more propelling situations to look at in 2013. And that's companies that are transforming from explorers, developers into actual producers. And in the particular case, as a client, Donna Metals. I mean, this is a company that is coming a producer, is not getting anywhere the valuation yet of what it can earn as a producer, and has been thrown out with the babies with the bathwater because of the overall market coming down. And then it's just projects that continue to be advanced while their share price went in the opposite direction. I mean, Geologic, Sunridge Gold, Spanish Mountain Gold, all of them just made tremendous progress on the corporate side, and yet their stocks are at the lowest points they've been in quite some time. And I just think, that can't continue. You can't. If we continue to have the corporate progress, eventually we get the repricing in the share prices, And the last thing I'll mention, and it's something that I haven't fully looked at, but hopefully when I write my New Year's report can comment more on, I think for the first time in years, the South African gold stocks are going to look attractive. The rand is finally coming off. The once every 10-year cycle of economic and political upheaval has run its course, and I think they've been so lowered valuations on them that they may be attractive as well. I mean, I have one client in there that I own stock with gold in that fits that criteria, but I just going to look pretty hard in the remainder of this year at the South African gold stocks, and if there's anything that really hits my eye, I hope to mention it in the New Year's commentary.
All right. Peter, what are you going to get me for Christmas this year?
2 tickets to a Giants playoff game.
Don't look now, but there's this team called the Washington Redskins that are hot on your heels.
Cowboys. This is amazing. Redskin fans are rooting for Cowboys. Cowboys are rooting for Redskins. What's going on? You guys are only one game back.
I'm not rooting for the Redskins. I'm just calling it the way I see it. They're hot, and everyone else really isn't in the NFC East.
Listen, last year when the Giants lost to the Redskins, I still have emails from friends that sent me, because they know I work with them, stuff they said. And when I mentioned don't ask me for playoff tickets, they went, playoffs? They're not even making the playoffs. Listen, this is a team that historically, and again, I'm around them. I'll be around them tomorrow. They seem to only propel when their backs get put to the wall. So, look, I'd be happy if you told me at the beginning of the year we had a 1-game lead with 4 games to go, and we'll take it from there.
Okay, fair enough. So who the Jets? The Jets don't have a quarterback.
Well, they have a quarterback. They just didn't use him. And, I hope this young man does get a chance, because I think Sanchez would be best for even himself to end up some other ways. But, they got to pay him $8 million next year, so he'll be the most expensive backup quarterback that they ever had.
Right.
But the bottom line is the team needs a whole new management group. I think both the GM and the coach need to go, and the owner needs to get a football-type guy, somebody that has an extensive background, to be his GM, and bring in a new coach, because I don't think he wants to inherit a coach. And I think that's going to happen. And who I feel for is it's obviously now been a total charade about Tebow. There never was an intention that they talked about how he was going to be used in the Wildcat. They were getting so beat up in the New York media after the Giants won for $1.5 million. As Eli liked to say, he went from the most talked about to the third most talked about quarterback when they announced that they acquired Tebow, and that was all a charade. It's come home to roost on them. They are the second-class citizens in New York compared to the Giants, and they deserve that recognition because they really pulled a farce on their fans. It's clear and obvious they never intended to use the guy in the manner they spoke of, and they kept pinning their hopes on a young man that unfortunately is part of his fault, but also the team around him is falling apart. There's a lot of people to go to blame here. One of my board members in my other company is the head of player development for the Jets, and I don't like knocking them because I know he's a good, hardworking man. But there needs to be a big shakeup at the Jets, and that's going to start at the top.
I hear you. Peter, this is our last show for the year. I'll leave you with the last word. Anything that you'd like to leave us with, whether it's business, politics, sports, anything? Last word.
Well, for me, I know that this season of time, people who are under anxiety and depression, it's the worst time of the year. People who are suffering through mental anguish see what perceives happiness around them, the jollies of Christmas and all. And so my goal for me, and I would encourage everybody, is to think about a person, even a stranger, of doing just a very nice human act in this holiday season. And it can go a long way, because this is in a really tough time for anybody that's facing, mental anguish. It's just, it is. And so I just would ask anybody to do just a gesture that can be as simple as speaking to someone, saying hello, or maybe finding out about somebody in your area that is going through a tough time, and maybe doing something that can help them.
And on that note, Peter, we won't be talking until the new year, but till that time, Peter, I want to wish you and yours a very Merry Christmas and a Happy New Year.
I want to wish you that too, and I hope Romo doesn't mind watching the playoffs starting in January.
Yeah, the best the Cowboys I think will do is 500. If they do 500, they'll be okay. But that's as far as they're going to go.
Okay, my friend. God bless and have a great holiday.
Excellent. This interview will appear on my website, corporateinterviews.com. It can also be accessed on YouTube and iTunes. Just type in Grandich in those respective search engines to not only access this interview, but interviews that we've done in the past. If you have any questions for Peter as we head into the new year, by all means, send me an email. My email address, very simply, al@corporateinterviews.com. We will certainly do our best to mention it on our next program. For Peter Grandich, I'm Al O'Grady. Thanks very much for joining us.